Welcome to the FIIG Securities Expert Series webinar. My name is Elizabeth Moran and I'm Director of Education and Research at FIIG. And today I have with me Graeme Colley, who is Director of Technical and Professional Standards at the SMSF Association. We're really fortunate to have Graeme here today. In fact, we've both been across at the SMSF Association Technical Day at the Brisbane Conference Centre, and he's very kindly agreed to duck out this afternoon and give us some of his wisdom. So Graeme has over 30 years experience in superannuation and we're absolutely delighted to have him here. But before I hand over to Graeme, just a couple of words, housekeeping if you like. On the right hand side of your screen you should be able to see a panel, and if you can't, there'll be an orange arrow there. If you click on that, that will expand the panel and then you can then see further down that panel an area where you can ask us questions. So we will attempt to answer some questions as we go through. Please send in your questions and we'll see how we go. If we can't get to all of your questions, we'll try and answer some at the end of the webinar, but I would encourage you to think about making your questions fairly short and to the point because there's so many people on the line today. We have over 1,000 people listening to the webinar. The best chance you've got of us answering your question is to make it short to the point. So without further ado, I'm very delighted to welcome Graeme here.
Thanks very much, Elizabeth, and welcome this afternoon to everybody. What I plan to do this afternoon is go through where we are with superannuation at the moment, particularly in view of the number of government inquiries that have been held over the last 5 or 6 years, I would suppose. But first, I'll let you know a little bit about the organisation of which I'm the Head of Technical and Professional Standards. That organisation, the Self-Managed Superannuation Funds Association, is regarded as, well, we regard it as one of the peak industry bodies on self-managed superannuation funds in Australia. We represent advisors and also which consist of accountants and financial planners and administrators, so all the professionals in the industry. We collaborate with them, and we also put the views for usually self-managed superannuation funds, but also views about superannuation to both the government and the public sector to give them some idea of, and a little bit of balance sometimes, as to where we think superannuation should be going forward. And in a number of the inquiries that I'll talk about this afternoon, we've certainly had some influence there over the time, just like many other organisations do. Now, what I'd like to start with, while this might sound a bit of ancient history to some of you, way back in 2008, Jeremy Cooper was appointed to look after a thing we now know as the Cooper Review, and that looked into superannuation. And way back in May 2009, they commissioned Jeremy to look at the whole range of things relating to superannuation, and they came up with a report which was basically simple super, and making sure that it was more efficient than what the government had thought it was prior to that time. We finally saw the report come out from the superannuation system inquiry, and that came out in early 2010. And the main issues that came out of it were about some fairly simple things, about accountants' limited licensing, about auditor registration, about financial planners and their taxation qualifications, and there were a number of technical changes that came out from that. They included things to do with off-market transfers. Now, that didn't eventually make it, while it was nearly in legislation. The actual legislation which would have required all superannuation transactions to be made on market, then that would have made it very difficult, and in fact in some cases that would have been in breach of the corporations legislation. So the government decided not to go through with that. We then saw some valuation guidelines come out of this committee as a recommendation, and subsequent to that all superannuation funds, including self-managed superannuation funds, need to have their investments valued on a market value basis. The market value basis for some investments is relatively easy. For other investments, it can be very, very difficult and quite tricky, particularly where there's no real market for those investments. And one good example of that would be artworks and collectibles. We've subsequently seen, only in the last year, some changes to the law relating to insurance, where new insurance policies taken out by superannuation funds are required to be consistent with what we call the conditions of release. Now, conditions of release relate to the death of the individual, so you can have an insurance policy, a new insurance policy in the fund since 1 July last year, being in relation to life insurance, or you can have it in relation to permanent disability, or you can even have an insurance policy there which would pay out temporary disability insurance. So that alignment means that from the 1st of July 2014, it's not possible to take out insurance such as trauma insurance policies through a superannuation fund. Trauma policies were mainly linked in with self-managed superannuation funds and usually not in the largest superannuation funds. Another change that the Cooper Committee brought through were related to artworks and collectibles, and subsequent to that change from the 1st of July next year, there's certain things that a superannuation fund that has artworks and collectibles must store them in the appropriate place. You can't store them on your own property as you may have done in the past, and they need to be insured, and if they are, and they can't be on the premises, so they've got to be stored externally or in a gallery or somewhere like that. Another thing that Cooper recommended was a review of limited recourse borrowing arrangements. These are arrangements where the superannuation fund borrows, and with the amount that's been borrowed, it will purchase an asset which will be held in trust for the superannuation fund until such time as the loan's paid off. Now, the recommendation of the committee, because in 2007 there were new rules brought in about limited recourse borrowing, was merely to review that, the limited recourse borrowing arrangements. That seems to have come through in another review, which I'll talk about a little bit later. The other things that came through from the review was also the introduction of penalties for self-managed superannuation fund trustees where they breached any of the rules, and in those cases there were a range of penalties that were brought in, and the main reason for that was to get away from having penalties imposed by the courts, which was lengthy, it was expensive, and it meant that it was pretty difficult to impose those penalties anyway. So that's some of the changes that were brought in by the Cooper recommendations. So I don't know whether you've got any questions now, but I'll just give it a couple of seconds if you want to ask those questions, and if you do that, put them down in writing, then we can have a look at them and answer them for you.
We do have a couple of questions, Graeme. So the first is from Brian, and Brian's wondering, how do you get the views or the ideas of the SMSF trustees to present to the reviews, like the inquiries? So how do you gather from your members their views and put forward their views?
Okay, the way in which we do it is that we've got a board who represents a broad group of people, both from administrators, and those administrators, some of them have got around about 10 to 20,000 mum and dad trustees, and we collect those, or they collect our views for us and put that to our organisation. We also get people off the street. Brian probably never heard of us before, but if you send us an email, Brian, we certainly have a look at any suggestions that you and other people might have in relation to that. I mean, some of the things to do with artworks and collectibles, while the recommendation was made as part of the Cooper Committee, we came to a compromise with both Treasury and the government on where we would end up with that, and that was assisted by our members who have got mums and dads as their clients, and also from people writing into us. In some cases, it was the Art Galleries Association. They wrote into us. They're certainly not members of our organisation. And clients that dealt with them also contacted us to indicate a compromise between what was proposed and what we ended up with.
Another very good question here, Graeme, from Jeff. Jeff says, what amount of pre-processing of data should I expect before passing to an accountant? And should I keep a set of books? He's got a question here, accountant touted links to a BGL package, but I'm not sure what that means. Maybe you know.
Yes, well, that depends on whether you want to make it a do-it-yourself, self-managed superannuation fund, or you want to hand that information over to your accountant or use one of these packages to actually record that information. So that's really an agreement between you, the accountant, and the auditor, and even an administration organisation that you would use. Now, BGL is a package just like any other accounting package. That BGL package is certainly adapted for self-managed superannuation funds. They're probably one of the larger administration platforms that you can use for this. And it really comes down to you and your accountant as to what level of information you need to provide to that accountant, what work you'll do to put that down for the accountant, or what you'll hand over to the accountant so they can do that. So it really comes down to an agreement. Sometimes the client likes to do the whole thing. In other cases, they will do as little work as possible because they don't see themselves as being accountants. But often you'll find that they will have a checklist, and that checklist might go through things like share certificates or information about share purchases that you've got, other investments that you may have entered into during the year. They might even be after some valuations, but often the accounting packages automatically get some of that information anyway.
Just one last question before we move on. I had Penny and Alan ask about POI checks with a question, so maybe they're not sure what POI stands for.
Okay, well, thank you very much for that question, Liz, and also Penny. But POI checks there was the introduction of proof of identity checks, and the main concern there was with money laundering involving self-managed superannuation funds. The government proposed through the Cooper recommendations that a proof of identity check be put in place for those people that were setting up superannuation funds, and also in relation to money laundering. Now, the government didn't go ahead with that, so some of those things I've got there on that list, while they were definitely recommended by the Cooper Committee, the government decided that they wouldn't go ahead with that. So proof of identity checks, while there may be a use for those, the government thought that that was a little bit complicated. There are other ways of doing that through the underlying investments of the superannuation fund, and you as a trustee of that fund needing to show that you met the 100-point check in relation to the investments that you were going into for your superannuation fund. Okay, so thanks very much for those questions. They're all excellent. Now, the other thing that the Cooper Committee came through with, and I'm sure that you that have got your own self-managed fund and use accountants or financial planners will probably find that this will be of some use. Now, one thing we saw from the recommendation of this Cooper Committee was that from the 1st of July 2013, now that sounds a little bit a while ago, but there was this arrangement for introduction of limited licensing for accountants. And what that meant was that prior to that, the introduction of this, that accountants could provide advice in setting up a self-managed superannuation fund. When this originally came in, this was some time ago, around about 10 years ago, it would have meant that anybody that set up a self-managed superannuation fund would have to be a licensed financial planner. But there was an exception provided for accountants, and that runs out on the 1st of July next year. But as part of this arrangement, what the government's done is that it's required accountants, if they want to get into what we call a limited licensing arrangement, where they can provide limited advice in relation to setting up a self-managed superannuation fund, then they can do so from the 1st of July next 2016, but they will need to have a license to be able to provide that information. Now they don't need to have that, despite the fact that there was a change on 1 July 2013. It runs in parallel at the moment, so you can have a license, or if you don't have a license, then you've got to provide certain information about setting up the fund. Now from the 1st of July 2016, all accountants who provide any advice relating to self-managed superannuation can have a limited license which allows them to give advice on superannuation products. Now that would be setting up a self-managed superannuation fund or becoming a member of a large superannuation fund. They can provide limited advice about securities, and securities include basic information about shares, bonds and those sorts of things. Information about simple managed investment schemes. Now what I'm thinking of there is some of these managed investment trusts that are around, and there's a definition in the corporations legislation about that. And they'll be able to provide advice relating to general and life insurance, and also what we call basic deposit products. So they would be about cash management trusts and bank accounts and things like that. Now you may find, even though the accountant might have a license, they may not wish to provide some of this advice, and it's not because they're not allowed to, it's because in some cases they may not see that as their role. They might see that as the role of a financial planner, or they might see it as your role as trustee of the superannuation fund. So you might see that the accountant mightn't want to provide information about the products, but they'll certainly be able to assist in setting up a self-managed fund, showing you how to run a fund, how the rules operate in relation to that, and they might also want to get involved in giving some advice relating to insurance and basic deposit products. Anyway, I don't know whether anyone's got any questions about that or any other things there.
Yes, there's a couple on insurance, so it was good
that
you just mentioned insurance. So we have Courtney wanting to say, did you actually specifically say crisis insurance, and is that permitted in an SMSF? While Colin just asks, could we be a bit more specific about what insurances are allowed through an SMSF?
Okay, well, crisis insurance there, I assume you're meaning what policies refer to as trauma insurance. Now, trauma insurance is where you might suffer a traumatic event. That might be a breast cancer, for example. It might be a heart attack. It might be some accident, those sorts of things, where that traumatic event you need a payment to tide you over. Usually the payment's made as a lump sum. Now in the past you've been able to provide that through superannuation funds, particularly self-managed super funds, but you haven't been able to provide that as a new policy. While previous policies or ongoing policies can continue on trauma insurance, you won't be able to set up new policies in relation to that crisis or trauma insurance that you've got there. Now the types of insurance that you can provide through a superannuation fund, they're fairly traditional types of insurance. That is life insurance, so on your death, you can take out an insurance policy in the superannuation fund. On your death, the proceeds would come in, be credited to your benefit in the superannuation fund, and then be distributed under the rules of the fund, either to you, to your dependents, so that might be a surviving spouse, to your surviving children, or it could even be through to your estate and then distributed to the people that you've nominated as beneficiaries under that estate. So that's the life insurance. Now the other types of insurance that can be taken out is permanent disability insurance. So it might be for loss of an eye or a leg or an arm or something like that, some sort of injury that you might sustain. You might be able to work after that, so it's got to do with the fact that you've sustained personal injury, which is usually physical or mental injury, and you're unable to perform in any employment for which you're qualified. So that is permanent disability insurance. The other type of insurance that you can take out is what we generally refer to as salary continuance insurance, or you might like to refer to that as temporary disability insurance. So you might be off work for a time, it might be your insurance policy might pay you a benefit on being off work for 90 days, for example. So after 90 days, that temporary disability insurance policy is triggered, and that ties you over until you're able to go back to work, or in some cases, because of the type of injury you've got, they may then, after a particular time, maybe after 2 years, treat you as being permanently disabled, and then a benefit would be available under that policy under the permanent disability provisions. So firstly, it's the life insurance on your death. Secondly, it's permanent disability. And third, it's salary continuance or temporary disability insurance that you would have there. Okay, we don't have another question, so we move on from that. Now, the way in which it works for the licensing arrangements, if you have a look at what I've got on the screen here, it's those applications for the limited license arrangements for accountants have been in place since 2013. Not many of them have applied for the temporary license, the limited license yet, mainly because I think they're waiting to the last minute. They better get hurry on anyway, because they will need some qualifications in relation to financial planning before they can do the advice under the limited license. So that at the moment we've seen about 150 applications for limited licenses go through. Around about 50 or 60 of those have been approved by the Australian Securities and Investments Commission. So that by 2016 they'll need to get their house in order to be able to provide the limited advice under the current arrangements. Now, if you have a look at the bottom line there, I've got a continuous line there which talks about the thing called a full license. What we are seeing is that accountants are taking over or purchasing financial planning businesses, or they've got some joint arrangement with a financial planning business that runs a full license. So accountants going forward will either provide the advice under the limited license they've got, or they might join together or link in some way to a financial planning group, and then from that they can go ahead and provide any advice relating to self-managed superannuation funds. Don't know whether we've got any questions there. Okay, we'll keep going on that. So the other thing that's recently come into relates to financial planners and taxation advice that they give. Now, while in the past financial planners have been giving taxation advice, the accountants got a little bit upset about that, and the main criticism there was that they weren't properly qualified in providing taxation advice. So what will come in from next year is that under the arrangement that the government now has got with financial planners, is that if they've got a tax advice license with the Tax Practitioners Board, that they'll be able to give factual taxation information and planning advice in relation to taxation. And that won't be what we refer to as a full tax agent's license. It's only in relation to taxation advice on the products the financial planners are allowed to talk about. So a full taxation license looks into a whole broad range of things. It talks about providing tax returns to the tax office and all those sorts of things, in addition to what the financial planners will be allowed to do under the new arrangements that will be put in place for them.
So, Graeme, really you should check your accountant's authority to give advice on certain matters, because that's changing. Yeah,
that is changing from 1st of July next year. If you're setting up a self-managed superannuation fund, or you want some advice about that self-managed fund, the accountant will need to have the license, that limited license, or using a full financial planning license. Now, where you've got financial planners, and those financial planners are giving you tax advice, and tax advice would include things like salary sacrifice to superannuation. It might be about capital gains tax in your self-managed superannuation fund. Then they'll not only have to be a financial planner, but they'll also have to have a license which allows them to give tax advice, and that license comes from the Tax Practitioners Board. I haven't seen any of them yet, even though we do deal with the Tax Practitioners Board pretty regularly, but we'll start seeing those coming out fairly soon, beginning of next year.
Great. I've got a couple more quick questions.
Yeah, sure.
I have one from Graeme here, and Graeme says, I have an SMSF which receives compulsory wage-related payments made by an employer. I'm advised that I need to have an electronic service address as part of a SuperStream implementation. Can you please explain about this?
Yes, now there's some good information on the ATO's website about this, Graeme, and since the 1st of July this year, it's been necessary for self-managed superannuation funds where you've got a large, what we call a large employer or a small employer. You might think that covers everything, but a large employer is an employer who's got more than 20 employees, and a small employer is one that's got less than 20 employees. And there has been a transitional period where both of those employers have been required to comply with these new rules. Now, what probably would have happened with you in the past, Graeme, is that if you were employed by, and it's not your company, you're employed by an organisation, say you were employed by BHP, then you would have provided your tax file number, I would imagine, for your superannuation fund, details about your account, the account of the superannuation fund, so that BHP could make those contributions to your superannuation fund. Now, because of changes which came in with this Cooper Committee some years ago, one of the main criticisms was that superannuation funds were living in the dark ages and they weren't up to date with the electronic age. Now, you might think that wasn't the case, but I can assure you that some superannuation funds were certainly living in the Stone Age. So as part of the modernisation of superannuation funds and what we call the SuperStream arrangements, the government decided that there should be electronic transfer of funds because in the past there were cheques, believe it or not, cheques where the contributions were made to the superannuation fund. So now what you need is not only information about your superannuation fund, the bank, which includes the bank account and the ABN for that self-managed superannuation fund, you also need a provider number, and that provider number is an electronic key between the employer and your superannuation fund. It still goes through the same sorts of processes to get the money there. It requires that the larger employers get the money into your account much more quickly than they were required to in the past. Now, where do you get one of these numbers from? I suggest you have a look on the ATO website, put in the words SuperStream, and it will come up with a list of electronic service providers, and it's for you to then get in contact with those electronic service providers. Some of those numbers that you get, you need to pay for those, but others, there's a couple of there where they provide the number free to you. Now, the ATO won't tell you whether you've got to pay or you don't have to pay, but I do suggest you look at a website by the name of www.solepurposetest.com.au. Have a look at that website. That's www.solepurposetest, solepurposetest.com.au, and have a look at what they've got under SuperStream, because they've got a list there and they tell you whether you need to pay or whether it's available to everybody or just to clients. It's a very, very handy website to have a look at anything to do with superannuation, but particularly for the electronic service address. It's got nothing to do with my organisation, it's just one that I've come across and I find it very useful for these sorts of things.
That's fantastic. That's so good to be able to tell people where to look, because I think that's one of the things, you just don't know where to go or how to find, you know, what do I pay for this, or who can issue it to me. So that's fantastic, that sole purpose test website. Great.
Yeah, what we get, I mean, people ring us up and they complain that they've got to pay for something that works, works now for my self-managed superannuation fund. Why do I have to pay for something that does exactly the same job? So if you have a look on that website, you can see I think there's 2 or 3 there where they provide that number free to you. Now, I've never used them, but I'm sure if you give it a go, you'll find out the ones that work the best for you.
Okay, I've got another couple of questions. David says the sole purpose website didn't work for him, but I'm not sure why that may be. Maybe it was down, or. But Michael asks, do these SuperStream providers have a reporting obligation to the ATO?
Yes, they most certainly do. Yeah, the ATO, through a whole range of electronic things, keeps an eye on these organisations and they report to them about how it's going. And Philip Hind, who's looking after that project in the ATO at the moment, is certainly well in touch with these electronic service providers to make sure the system's running very smoothly. We've only had it up and running in its fullest capacity for the last couple of months.
Do you know what? I've just had a lovely couple of people write in. Thanks to Eric, Victor, Graeme and David, who've all said there's no .au on the end of solepurposetest.com. It's just .com.
Oh, is it?
No
Oh, my
there you go. So now it's fantastic. So,
my apologies. Okay.
Thank you all of you.
So for David, take off that AU. My apologies to you.
No worries. Now a couple of other just quick questions. Brian's saying he doesn't get all the notifications of his distributions for the 30th of June until sometime after. So he obviously just then has to wait until he gets the distribution letters and then he can work out his tax once he has all his information to hand. Is that right?
Yes, that's right. In some cases you'll need to wait, particularly if you've got investments in private unit trusts and some private companies, simply because of the way in which the valuations are made. And I know I've had clients who like to get their returns in as early as possible so that their super funds can get a refund of their franking credits. But yes, unfortunately, just like you and like our personal tax, we need to get all that information together. Often you see it's on the ATO website anyway. If you go through MyGov, for example, it'll have a lot of investment information there, even though you may not have the certificates from in relation to the various dividends and so forth.
So one last question, and I think it's a really good one to end the accountant section of the presentation, if you like, and it's from Gary. How are you today, Gary? Gary asks, is there a guide to what we should expect to pay for, say, doing a tax return for an SMSF, or for doing most of the trustee work, such as the trust deeds, as well as the tax return? He asks, is it roughly a percentage value of the fund, not including any financial planning advice?
Very good question. I would say, it's as a percentage of total assets. I would say if you're paying a percentage of total assets, then you really need to look at the service, because it should be based on a fee-for-service arrangement. Now, an audit for a self-managed superannuation fund, the average price for that, and I'm basing that on my experience and also some of the statistics that the ATO's got on that, it's around about $500 to $600 for a fairly ordinary type of superannuation fund. So you might have some shares in it, some fixed interest type investments and so forth. If it's not too fancy, then around about $500 to $600. That's what the basic price would be. If it's more complicated, that is, there's been many share transactions in the superannuation fund, or there's been pensions paid in that super fund, you can expect to pay a little bit more than that. I mean, some hundreds of dollars, certainly not into the thousands. For the accounting side of things, it just depends on the effort that's required by the accountant or the amount of effort that you put in. So you might contribute and assist your accountant in getting the accounts up and running. In fact, in some cases, I've seen it where the client actually does an excellent job, just provides that to their auditor, and the superannuation fund gets audited. So it's a fairly, from a cost point of view, it's a relatively cheap thing. But looking for a self-managed superannuation fund, I mean, an average price might be $1,500 to $2,000 for accounting audit, maybe some administration there. You're certainly seeing that's well in the ballpark for most superannuation funds, and maybe you can get that a bit lower, just depending on the information that you provide. Financial planning fees just depends on the complexity of the superannuation fund and what stage you're up to, and I really can't give a price on that. But I do see some big superannuation funds where they've got a lot of money in there, that the accounting and audit fees are well into the $5,000 to $10,000 plus. Okay, well, I won't go through, they've got some slides there which I'm sure you get copies of, talking about how financial planners are impacted by the new rules. And here's a little bit of a mud map here on how financial planners should provide or permitted to provide taxation advice where they meet what we call they've got to notify the Tax Practitioners Board at the moment. That will finish on the 31st of December, and there's a transitional option which has got to do with them becoming qualified before the 30th of June 2017. Now, if they don't put down their name before the end of this year, there's what we call the standard option there, where they've got to meet the qualification requirements from day one to be able to provide that taxation advice in relation to their superannuation arrangements. Now, what I think is happening at the moment with financial planning advice and what we might see over the next 5 to 10 years is some sort of convergence there, both the financial planning side of things and also the accounting and the tax advice. That's because you're seeing accountants requiring licences to give self-managed superannuation fund advice, and for financial planners, if they want to give limited taxation advice, then they'll need to have a licence there too. So they're really taking on a bit of each other's role in the financial planning and accounting side of things. Now, one of the other reports that we've seen is what we call the Murray report, and you've probably seen a bit more than that in the newspapers over the last year. It was headed up by David Murray, who looked after the Commonwealth Bank, and he did an inquiry into what we would refer to as the financial systems inquiry. Now, when it came down to self-managed superannuation funds, the final report had little to say about self-managed funds, apart from the fact that they were pretty well run and they formed an integral part of the superannuation industry. Now, when you had a look at the interim report, you might have been a bit worried because they mentioned there that maybe self-managed funds should have a minimum balance, that there should be limitations on how they're established and the costs associated with self-managed funds, and maybe they should introduce restrictions over particular investments the fund should have and so forth. We didn't see that in the final report. In fact, all we saw in the final report, apart from the fact that they thought self-managed funds were well run, was that direct borrowing by self-managed superannuation funds should be prohibited from a particular date. This relates to a very small proportion of all self-managed funds. In fact, it's only 1.6% of the total assets in self-managed super funds that have actually gone into what we refer to as a limited recourse borrowing arrangement, where the super fund borrows, it then uses that money to purchase usually real estate, but you can do it with shares or fixed interest securities, to put that on trust until the loan's paid off. When the loan's paid off, those investments get transferred across to the superannuation fund. Now, subsequent to that, we've seen ministers, both the Assistant Treasurer and the Treasurer, come back and say, well, maybe we'll have second thoughts about accepting this general prohibition on limited recourse borrowing. We'll have to wait until around about mid-August, so a couple of weeks' time, while we wait for the government's response to this financial systems inquiry. But we feel, as an association, and the discussions we've had with both Treasury and hearing what the ministers are saying, that maybe a compromise position might be reached. Now, the main reason why the government and the report, particularly the Murray report, has objected against superannuation borrowing is that most people think that self-managed funds have had something to do with the inflated property prices in the capital cities. It's only $8 billion, the total investments from the loans. I don't think that's even one suburb in Sydney or Melbourne, so it's a very small proportion that self-managed funds have been involved in. The main concerns about the magnified risks of borrowing, concentration of assets where you've got small superannuation funds that invest in property, that the fact is that it's not really at risk to the lender and things like that. But we'll see what the government comes out with. I don't know whether anyone's got some questions on that, Elizabeth?
Just one from David. He's asking, what about foreign investment and low interest rates?
Foreign investment and low interest rates. Well, you've always got currency risk with foreign investments. We see that with the value of the Australian dollar at the moment. Low interest rates. It's interesting, you see the media talk about, and a number of public figures talk about how the government should do something about maybe reducing the minimum amount of pension that you take out, that superannuation funds are not providing high income simply because of the low interest rates on fixed interest and so forth. But if you've got a diversified portfolio, and if you have a look at some of the larger superannuation funds, the returns that they've provided over the last year are far higher than 2 and 3%. In fact, I think one of the surveys recently said they were around about 9, 10, 11, 12%. So that's not a bad result, and that's last year when the interest rates on savings bank accounts certainly went down. But because of the diversification of those portfolios, they're doing reasonably well, certainly above the long-term average of around about 7%.
Let's keep going. There's a couple of questions that I still have, but I think I'll leave them towards the end.
Okay.
So, yeah.
Now, I'll just go quickly through these things about the financial services inquiry. I mean, looking at one thing that they were trying to do was get broad political agreement between all our politicians that the superannuation system should have bipartisan support. Well, I wish the politicians luck in that, but anyway, I suppose we can all smile when we see those sorts of things come out of these sorts of inquiries. Another thing which is more interesting, I think, is the review of Treasury, which is currently taking place, which does link into some degree to the financial system inquiry. It talks about the development of what's referred to as comprehensive income products for retirement, and that is the development of, in drawdown stage, to assist with the longevity of the sorts of superannuation that we might have accumulated during our working life, and allow more flexibility compared to the type of benefits that we can draw down either as a lump sum or as a pension under the current rules. Now, that's got to have a look at the longevity aspects of it. It's got to have a look at the life expectancy of the actual pensioner, if it's going to be taken out as a pension, and the way in which, whether there should be minimum drawdown requirements or there should be a maximum amount that you can draw out from your superannuation pension each year. Now, the financial systems inquiry didn't give any conclusion there. It merely said that we really should review this because we're moving away from a time when we were looking at accumulation of wealth for retirement to a stage where, with the baby boomers moving on, now maybe we should be thinking about how that money should be drawn down. So that had a look at it, and I'll talk a little bit about that in the last few slides that I've got here in this presentation. One other thing there was the observations of the inquiry on taxation. And if you have a look at the little graph that I've got here, on the top, on the right-hand side of the chart here, I've split that into the the deciles of income, and the inquiry looked at both the 9th and 10th decile and said, well, if you have a look at how the cost to government is of superannuation, then those that are in the wealthy 20% of taxpayers benefit most out of the superannuation system. Whereas if you have a look at the left-hand side here in that 1st and 2nd deciles, in fact, in the 1st decile, it's actually negative. That is, that you pay more by putting money into superannuation than if you would have put it in your own pocket. Now, we have seen some government initiatives there, one called one which allowed a tax offset, simply because for very low income earners, they were not paying any income tax, but when those superannuation contributions were being made on their behalf, the amount put into superannuation was being taxed at 15%. So through the low income superannuation contribution, the government would compensate for the amount of tax that was paid by those low income earners. That won't be there after 2017, so I wonder what the government's going to do in the meantime. But it certainly shows you, from the government's expense point of view, that upper income earners, it costs the government more for the upper income earners than the amount that goes into superannuation on their behalf. So I don't know whether we've got any questions there, Liz?
Oh, we've got a couple, but I think let's keep going.
Okay,
I'm conscious of the time, and let's we'll save the questions till the end, I think, now.
Okay, well, the taxation white paper was interesting from the point of view that it came out last year. We've been waiting and waiting and waiting, or because of my type of work, I've been waiting and waiting and waiting, I should say. I'm sure many of you didn't. But there's two issues that are raised in the tax white paper that we think impact upon superannuation. The question 20 there is about to what extent does the dividend imputation system impact upon savings decisions. It's not only your personal decisions but also the superannuation fund. Dividend imputation certainly gives an advantage because the company tax gets used as a tax credit against any dividends that you or your superannuation funds receive. So we want to keep a bit of an eye on that. We've certainly set our piece that the dividend imputation system does fulfil a worthwhile purpose, and superannuation funds, if there's a refund there, certainly still should be put in place. The other thing is about the equity and the fairness and making superannuation a bit simpler. I think it's probably made a little bit more complex because of all the language that's used and all the special words that people will talk about with superannuation, so maybe we'll see some simplification out of that. The other things that the tax white paper had in there was how savings should be taxed, whether if you've got some bonds and you're getting interest from those bonds, for example, should they be treated in a very similar way to maybe shares, for example, because the money is held there in a fixed security like a bond for a long time. Should that be should there be some calculation there which takes into account the effect of inflation, because you might have bought a $10,000 bond after 5 or 10 years, depending on how long that's been invested. The value of that bond's certainly gone down in real terms. So should that be taken into account for, say, capital gains tax purposes and things like that? So should there be an offset there? So they're looking at that. The other thing is whether the superannuation tax settings are working, whether they're equitable, and I've showed you that the government doesn't think they are, and we've seen from the social security lobby that maybe, and the consumer lobby, that maybe there should be a restructuring of those concessions. Now, the way in which we see things for this on superannuation, this is just one of the ideas that's been put forward to government, is that we think that the status quo should be maintained. That's our prime lobby on that, but you've always got to have a plan B for this stuff, because politics is a moving feast at the best of times. And what we've proposed with this is that maybe that we do maintain concessions during the contributions and the earnings stage of superannuation, but when benefits are paid out of that superannuation fund, maybe they're above a certain level, and we're not putting a number there forward, but say above $100,000, $200,000, that a light tax be imposed upon the amount drawn out of superannuation. So up to, say, $100,000 or $200,000, the amount received be tax-free, but above that, because of criticisms of some very high balances in superannuation, maybe any amount drawn above that will be taxed in a very light way. So that's just one idea, and that's my association's lobby on that. We've maintained the status quo, but as a plan B, we then need to maybe look at the way in which the benefits are taxed. There's some good overseas examples of similar things to that. Canada's a very good example, which has got a good system in place and allows people to build up their retirement, and as they draw it down, providing they do it in a fairly equitable basis and a fairly even basis, they don't get penalised under the taxation system. There are a range of other ideas that we've got put forward, and not only us but other organisations, for ways in which we can simplify superannuation. We still think that some of the CGT small business concessions should be retained, dividend imputation should be retained, but when you look at things like what we call the 10% rule, which is a reasonably complex rule, which applies to self-employed people, and particularly some employees who don't have access to salary sacrifice cannot access a full amount to put in superannuation. So there's a couple of these things we think would work in their favour if they were abolished. And one is the 10% rule, that we maybe allow voluntary contributions after age 65 for people that aren't working. There's some other minor, fairly technical things there about definition of the Australian Superannuation Fund, which I won't go into, but it's to allow superannuation to be much more easier to understand and far more flexible in the way people use it. Now there is another inquiry that this is the last one I'll cover. It's the Parliamentary Joint Committee on Superannuation and Financial Planning, and what it's aiming to do is to increase the standard of qualifications of financial planners. And as we've seen in the media over the last year and prior to that, some financial planning firms have really copped it in the media, and both from the media and also from the Australian Securities and Investments Commission. Some of that's certainly warranted because of the activities of some of those financial planners, but maybe they're getting a bit of a hard serve. But what the government wants to see out of this Parliamentary Joint Committee is that things like product advice be quite clearly identified, and product advice by this is documents about particular sales aspects of investments. It might be some sales documents about particular managed funds that you've got there. But if you're providing financial advice, that be clearly identified, and financial planning advice or financial advice can only be provided by a licensed financial planner. So it's trying to make a bit more black and white the difference between sales and promotional advice that I give you compared to the actual financial advice that's provided by a financial planner. Now, the government's developed a register of financial planners. That's currently in train at the moment, and if you want to find out whether your financial planner is qualified or what their qualifications are, whether they might have self-managed superannuation fund qualifications, for example, then have a look on the register. That's available off the ASIC website, which is the Australian Securities and Investments Corporation. The other thing is the raising of qualifications for planners. So whether this is a good or a bad thing, I mean, that really comes down to the particular planner, I suppose, but it's to raise that to at least a degree qualification, and then if the financial planner wishes to specialise in an area, that they also meet those specialisation requirements. So at least that's going part of the way there. Now, the last thing there is the introduction of a professional year for financial planners, particular CPD requirements, and the committee recommended mandatory membership of professional associations. Now, while that's recommendations from that committee, you really need to hold your breath, because we've got to wait until we see what the government comes out with, and as to whether they would accept the recommendations of that committee. Now, the last thing I'll go through is the review of retirement income streams, which is a review by the Australian Treasury, even though the paper here is under the Australian government. And like I referred to before with the Murray Committee, it's looking at how income streams should be reviewed in Australia. These are some of the charts that have been provided. Now, you might think this is a bit confusing, but what we've got with this is the way in which income's drawn down. So if we were to take, say we had $200,000 in superannuation, that's on the left-hand side of this chart, and then we drew that down according to the minimum rules, not the maximum rules, the minimum rules, then that blue line, that blue sort of curved line there, will be the way in which we would draw that down to age 100. Now, if we were to draw that down a lot more quickly than that, then it would be the purple line that we've got there. So the government is looking at this from the point of view of how long will this income stream last. In this case, it will last to around about age 100, but as you see, the balance drops down quite considerably, and the amount of income that you would draw out of that does drop down as well. So the government's looking at that at the moment as to whether this sort of profile is the right way in which income streams should be drawn down, or there should be another way, and we haven't seen any recommendations from that. Now this looks at the impact of a first-year investment shock. So say somebody was 60 in 2008 when the GFC came out. This might be typical of the sorts of ways in which their pension would be impacted. So you're seeing with that red line there's a huge drop in the value of, or a large drop in the value of that balance there, and it means that the person will end up with so much less in drawing that income stream down. So that's the sort of things we're looking at. Now I don't have any answers for that at the moment because it's still under review, but we'll see what happens with that.
Well, we do, of course, Graeme, and that's to buy bonds. I mean, I normally don't say buy bonds, but, you know, that is part of the defensive strategy, to own an asset that doesn't, you know, isn't revalued by so much, or that you lose capital, that you ultimately hold to maturity and you get your capital back. So there you go.
So a nice diversified portfolio is exactly how it would work.
Perfect segue there. I'll let you keep going. We've got some fantastic questions coming in, so we'll get to those in a moment.
Now, what we've seen, you really wonder at the moment with some of the statements that's coming out from particularly our Treasurer as to whether they're trying to take superannuation off the front page. Now, why I say that, while we might read newspapers electronically, last week we saw Joe Hockey come out with this statement at the Pricewaterhouse Tax Reform Forum in Melbourne, and he said it's staff delay any additional changes on those planning for retirement. And you wonder whether the effort that's being put into the tax white paper will actually include things on superannuation. So I'm not giving you any guarantees there, but that's a fairly nice indication there. And with this other statement he made at the same conference was the government absolutely rejects the view that the solution of the nation's ills is to slug those who are taking responsibility for their retirement with higher taxes on superannuation. And I know both Joe and also the opposition spokesman for in Treasury, Chris Bowen, both don't like the fact that if the economy goes bad, then superannuation can always be used as a stopgap to pay for infrastructure or education or health or whatever it is. So they always, both sides of politics, make those sorts of comments. So I don't think we're going to see superannuation as the poor cousin. Now, that's my piece for today. So what about these questions?
Oh, there's some fantastic ones, and there's actually a couple that I got early on that I've been waiting for, and I'll ask those last. So, but there's a couple of really great ones here. David says, and they're actually asking you for your thoughts, Graeme, so listen carefully. So David asks, well, he suggests that it is fair to put limits on amounts invested in super at concessional rates. But thereafter, once the money's in super, there should be no penalty for making good investment decisions. What are your views?
Well, I think you're right, David. I had a look at when you have a look at what the government did way back in 2007. That was Peter Costello and the Howard government. I thought it was excellent because what they did, they moved the measuring of benefits at the end, that what we used to call the reasonable benefit limit system, and then they restricted the amount. I mean, it's still generous, the amount of contributions you could put into the fund. That meant, from an efficiency point of view, that you could still put those contributions in, and if you were a good investor, like you're suggesting, then you weren't penalised in any particular way. Not like the way in which the reasonable benefit limit system worked. That was that if you took too much money out at the end, or more than you were allowed to, that was the extent to which the government was prepared to go, then you would be penalised for that. And this new system that was brought in sort of brought all the restrictions to the front when the contributions were made, but it still allowed you to invest as efficiently as possible. That's still the way in which the current system works, although those contribution limits have been restricted. And we're seeing some changes there, of course, over some recent amendments where the penalties for excess contributions into superannuation are not as severe as what they have been. So, great idea, and it was sort of in that introduction by Peter Costello way back in 2007.
Okay, got a couple of other quick ones here. Brenda asks, what's the difference between my ABN and the provider number needed to be given to a large employer who is paying super into my SMSF?
Okay, well, when you first register your self-managed superannuation fund, you're given an Australian an ABN, and you're also given a taxation file number. They're there for taxation purposes, and there's specific purposes for which those numbers can be used. Now, they're not allowed to use the, believe it or not, they're not allowed to use the ABN for this super stream arrangement, because that's a breach of the privacy provisions. Now, you just got to bear me out on that one. But the provider number relates to the particular provider that the employer will link into for the distribution of that contribution into your superannuation fund. That's sort of like an electronic bank account in a very abstract way. So you can't use the ABN for the types of things that the provider number is being used for, unfortunately.
Okay, that sort of leads me into a question that we have from Stuart, and he's just saying that his understanding and wanting some clarification was that not all SMSFs are required to use SuperStream, that there are exemptions for funds which receive contributions only from related party employers. Is that right?
Yes, that's quite right, Stuart. This usually relates to small employers. So if you're a director of your own company and that company makes contributions to your self-managed superannuation fund, you would be treated as what we call a related party. And in those circumstances, there's no requirement for you to meet or satisfy the SuperStream requirements. But if you work for a large employer or somebody who you're not a director of or not a shareholder in, and you're not regarded as a related party, then you will still need to meet the SuperStream requirements.
Okay, we have a question from Russell, and Russell says that a basic principle should be no retrospective. Oh, I'm not going to get that word.
No retrospectivity?
That's it. You've got it for me. Thank you. Any earnings above, any earnings tax above a threshold should only apply on additional assets made after the date of the change. It should not apply on assets accumulated in good faith prior to this. What are your thoughts?
Well, retrospectivity is in the eye of the beholder, I think. Yes, I do agree with you. It's very difficult in some circumstances to work out what's retrospective or not, but yeah, I mean, what you're saying there is very valid. You know, there should be a stop as to what those investments or assets are, and any accumulations after that time maybe should be subject to some new rules.
Okay, I've got a long comment from David, but in essence, he's saying that all the uncertainty in super is stopping people from making the most of it. And do you see this as doing more damage to retirement savings than the perceived imbalance of concessions?
Yes, I am, Elizabeth. Yeah, it's really really frustrating when you're trying to settle down policy like this, because I've been involved in this sort of stuff for many, many years, and people just get confused over the changes in the titles and things like that. And I think what Joe Hockey's saying in those recent statements is that, well, how about we give it a rest and we don't fiddle around with superannuation any more than we've got to. And I mean, he said that in this term of this government, which means more than this term, maybe we won't put in place any adverse or unexpected changes. So yeah, it's always very difficult when you're in this situation with all these changes that are going on. But
yes.
As someone said to me, take the opportunity when it's there, because it won't come back. And I think that's probably not a bad philosophy to look at. And if you have a look at superannuation over the years, those that take the opportunities when they're there are certainly the best. They're still better off than if they had not taken that opportunity.
That's a great way to look at it. Robert actually is asking, are the government concerned about people exiting SMSFs because of the uncertainty and the possibility of retrospectivity? I'm still not getting that word right. So are they worried about people exiting that or moving away from SMSFs because of the uncertainty?
No, I don't think the government is concerned. In fact, the reports and the government thinks self-managed superannuation funds, they represent a third of the assets in all superannuation. That's 1 in every $3 in superannuation is in the self-managed superannuation fund. Projections that are there will continue with around about that same percentage. We're certainly not seeing a drift away from self-managed superannuation funds. There's around about 20 to 25,000 new self-managed funds set up each year, and there's around about 10,000 or at the most actually close up every year. It just depends on the time, but it's a very, very small number of self-managed funds that are being closed. I mean, you're looking at around about 550,000 self-managed funds representing over 1 million mums and dads in Australia.
Okay, I've got going back to my 2 early questions that I thought were great to wind up the session. So this one's a little bit of a long question, but I really like it, from Walter. And Walter is retired. He sold his factory building, which was in the SMSF. The funds are sitting there at the moment, and he intends to buy bonds or annuities with the capital. The question is, if he draws the money to do these purchases, can he do it within the SMSF, or can he just close the SMSF? Because he can't see the point of keeping it going along with the expenses of running it. So he asks, are there any advantages in keeping it?
Ooh, very good question. You need to get some tax advice on this, because I only recently looked at this for a client who was thinking of closing this super fund. Now, I said to them, how much are you going to get as income from the investments if you were to do that in your own name, and how much tax would you pay on that? If they earn under the taxable tax-free threshold, which is around about $20,000, if you get some of the offsets with that, then you're not going to pay any tax on it, whether it's in super or it's outside super. So that's not a bad one, particularly especially if you're drawing a pension out of your superannuation fund. But if you're going to end up with taxable income on the investments that are held in your name, you really need to think about that and compare that as a cost, the tax you pay in your own name on that income. Compare that as a cost to the cost of running your self-managed superannuation fund. Because don't forget, if you you invest that money in your self-managed superannuation fund and you're drawing down an income stream, and once you get to age 50, or you're older than age 60, I beg your pardon, you're older than age 60, you won't pay any tax in the fund itself if you're drawing down an income stream, and you won't pay any tax on the amount you receive in your hand. So you need that comparison, comparing about if you invested in your own name, tax in your own, if you invested in your own name, compared to the way in which you might invest in your self-managed fund and not paying any tax in the fund itself and no tax on the actual income stream that you receive out of that fund.
Okay, a couple, just two more. So one is, we had a pre-question regarding a gentleman who owns bonds, and he was worried about what happens if he died and the bonds what happened to the value of the bonds and the transfer value.
Okay, it's a good question. Firstly, if you bought the bonds at face value, say you bought that at $10,000 for the bond, and then on your death, that bond goes through to your survivors as part of your estate, the value of that bond is not its market value. It would go through its face value there at $10,000, and when the bond matures, that $10,000 that comes into them won't create any capital gain in relation to that. So that's if you bought it at face value and you wait until maturity and the face value of the bond is given through to you. Of course, the interest income stream that comes from that bond is taxable income. In most cases, I mean, in some cases you might get some capital. There might be some capital issues around that. Now, if you happen to buy it off the market, say you buy that bond, even though it's got a face value, you might buy that for $8,000, and then that goes through on your death, and the value at your death might be, say, $9,000, even though it's got a face value of $10,000. Then goes through to the beneficiary, and when that bond either matures or maybe your survivor might sell that on the market for another price, then there may be a capital gain in there which is taxable. That is between the market value that you purchased to that, that you initially purchased to that, and the value at the time your beneficiary decides to sell that on the market, if they do it that way. So there's different ways in which the CGT rules, capital gains tax rules, can which will apply if you buy it on the market rather than buying it at face value and then waiting until maturity.
We definitely recommend that you get some advice on that, some external tax advice, I think.
Oh, absolutely, yeah, because we don't have any absolute detail in that case.
No. So like the last two questions, and they're sort of from Stan and Walter. Now Stan asks, does the SMSF Association allow trustees to attend specific sessions of the association's conferences? And Walter wants to know what are the benefits to him as an SMSF trustee of joining the SMSF Association. So perhaps you can wind that up with a bit of
a
plug for the SMSF Association.
I don't usually do these sorts of things, so. But yeah, I mean, if you not being a member, you're still quite welcome to come along to our conferences. Now, I must preface that with the fact that our members consist of accountants and financial planners. We don't have mum and dad trustee members at the moment. We're looking at moving that forward. So the benefits, well, we provide advisors, being it accountants or financial planners, with a series of publications that they certainly hand out to their clients about self-managed superannuation funds. But we're sort of developing that at the moment. That's a bit off the record, but yeah, we're developing that sort of membership at the moment, but that might be a few months off yet.
From my perspective and from FIIG's perspective, we've had a long association with the SMSF Association, and they provide fantastic services to professionals, and certainly we've found them one of the most technically proficient and very up-to-date on educating their members. So if you have one of your accountants or one of your advisors is with the SMSF Association, I think that's a big tick of approval in my eyes anyway. So this really brings us to the end of the webinar today. Thank you all for joining us, and my deepest thanks to Graeme. He's got a very busy schedule. He's actually due, he was in Sydney yesterday at the State Technical Conference, and he's flying tonight to Melbourne. So we very much appreciate you, Graeme, for stopping in and sharing some of your expert knowledge with our clients. So thank you very much.
Well, thank you, Elizabeth. It's been a pleasure.
Excellent. This now concludes the presentation. We will have a copy of the presentation. We will send it to all of you as per our usual method of operations. Thanks very much for